right, so let's start with just a basic question for each of you and your various roles. So Paul, most people know you're running the largest royalty and streaming company in the world at Franco-Nevada, something like more than 430 assets you're overseeing with your team. So maybe just a brief snapshot of how you see Franco's role in the markets and your day-to-day role. What are you doing on a day-to-day basis?
Well, thank you. Thank you for including us at this event. It's a terrific event each year, and it seems to get bigger and bigger every time that I come. You point out the size of Franco-Nevada. In one way, it's a very big company, and in another way, it's a tiny company, much smaller than Red Cloud, in that we only have 40 people in the business. So I have a very easy job in terms of running it. For my role, I probably split my time equally. Sort of 1/3 of it is managing a public company, managing our board. A third of it is dealing with shareholders and interacting with them, and the other third is on business development. And that's the fun side of the business. For Franco, we're a large player. Our biggest assets are all gold streams on very large copper mines. Those deals are $600 million, $1.5 billion is the biggest deal that we've done, and that's our bread and butter. But if you go to the history of Franco-Nevada, and many of you will know it, the original company that ran Pierre Lassonde, Seymour Schulich through the 80s and 90s was buying royalties on gold properties. And we always have that in our DNA. So when we're not busy on bigger stream transactions, we continue to look for great gold properties and also other resource properties, regardless how small they are. The mandate for the business development team is if they're big deals, work on those. If they're not, and we've got the time, we'll also work on smaller ones. So if you look at last year, we acquired a number of royalties. We did one with Magino as financing for them. We acquired incremental royalties on Eskay Creek with Skeena Resources, also on Marathon Gold on Valentine Lake. And so we'll step back and do construction phase, even smaller deals if the big deals aren't happening. We don't do a whole lot of exploration, but we do a bit. And a couple of examples in the last couple of years, we did a deal with West Haven to finance the exploration that they have at Shovel Nose in BC. Interesting project. And then another one more recently on the Wawa Gold project with Red Pine up in Ontario. And so we're on the hunt for good exploration projects. Most of what we do is in the gold sector, and we always say to shareholders, if it was always a good market to do gold deals, that's all we would do. But the gold market, like all resource markets, is cyclical. Sometimes it's too expensive, sometimes there's nothing going on. So we are open to diversified deals as well, up to 30% of our portfolio. Quite a bit of that has been oil and gas, and some of that comes from the having Seymour run the group for so many years, having that expertise. And but in more recent years, over time we've bought a lot of copper royalties. The outlook for the copper industry, I think, is fairly obvious as the most obvious winner in the electrification trend. And then we have spent a bit of time in lithium. A year ago, I would have said there's very little chance of getting it done, given where commodity prices are. But right now, with the big pullback in prices, there's a real need for capital, and so our group is spending time there.
All right, great. Now, Roderik, you founded Nebari in 2018, and you finance and invest in many different resource companies in various parts of the world. How would you describe, or let me ask this a different way, what was the genesis of your idea that you wanted to create this niche that you're operating in, and how would you describe it?
Well, thanks again also for the invite, this fantastic conference. When we started, so I started the company with 3 of my former colleagues. We were working at a large mining and trading house in Switzerland. And we saw that there was a niche in the market that to provide smaller ticket size capital for pre-construction financing requirements. So helping companies which they ordinarily tend to do with raising equity, putting this cash out there and helping them develop their finalize their feasibility studies, finalize their permitting applications, getting the project finance ready, and doing this on a basis of debt. And I think before, maybe 10 years ago, the general conception for junior mining companies was keep on raising equity until you have reached this stage where you can start to talk for the large streams, the large royalties, and the larger debt. We're not a company that does $450 million debt financing, maybe not yet, maybe one day I'll be very happy. But we saw this niche in the market, and our first deal was $2.5 million. It was a tranche facility with 3 tranches of $2.5 million. And typically we tend to be a secured lender. And then of course it's a lot of work to get to that stage because of the loan documentation, etc. But we've now done, I think, 36 different deals and closed over $290 million out of our first 2 funds. And we see that the interest is there. We see that the market is open. We see some other people doing similar things right now. And we think we're adding an extra form of capital into the mining industry, especially the junior and mid-tier space, which wasn't there around 10 years ago and is now there. And of course, coming back to the senior aspect, it's also a trust factor, right? Like, you're going to give us the keys if you don't pay. Are we going to take the house away or something like that? And that's really what I'm very proud of right now. It's over the last 6 years, we've done 30+ deals. We're really starting to be seen as a partner in the industry. If something happens, we're there to help you out. I don't want to own a mine in Australia and move there with my wife. I want to find a solution. I want to get you the extra money, explain to me what happened, we get over this hump together, and then we're going to have a success story all the way up to positive cash flow. So that's really, and it takes time. It takes time to develop that belief. It takes time to see that, okay, we can do debt, pre-project financing. It can be a part of our structure as we develop the project forward. But it needs to be done well with the well people, with the good people. And I think Nebari is slowly establishing the name and the reputation in the industry, still as a very small player, of course. But the space needs more money, and we're very keen to deploy that.
Now, John, at CI, you're looking for the best investments in the materials sector. So how would you characterize how you go about that and your role?
Yeah, so for those who don't know, CI is a $125 billion asset manager. I'm in charge of all the materials investments across the firm, so that I break that up into about 5 buckets, 3 of which I'm sort of what we call internally the research lead for. So those would be materials sleeves within larger funds, so a Canadian Balance Fund or a Global Balance Fund. And then I have 2 other mandates that are dedicated standalone funds. One would be a resource opportunities fund. That's a go anywhere, look at any type of commodity, in an attempt to try and outperform and generate alpha for our clients. And then the last mandate is our precious metals mandate, which is not really making active calls on precious metals. We've told our clients it's always invested 100% of the time. If they're invested with us, they obviously have a directional view in the gold price, so we don't make cash calls or commodity bets in that. And that's a bottom-up fund looking for opportunities in precious metals equities. Within the materials mandates, you tend to see a slant towards the Canadian mandates, just by nature of the TSX. So for those who don't know, the TSX is about 10% in materials, so we spend quite a bit of our time helping the Canadian fund managers, probably more so than the global and the US fund managers. Probably after Canada. Canada's about 10%. You go global actually before you go to the US. It'd be 4% of the global benchmarks would be in materials. But you start to see that the nature of the materials change more towards specialty chemicals and away from upstream resources in commodities like copper and gold that are more prevalent on the TSX. And lastly, when you get into the US, it's 2% of the S&P. That's basically specialty chems, steels, and Newmont and Freeport. So we're much more slanted towards focused on Canadian investments when it comes to the resource space at CI. And then our high yield team does look at metals and mining. And recently my group did a big deal with them for IAM Gold, a 2L loan, so a second lien loan secured on their Cote project, development asset in Ontario. But I would say that the general attitude towards metals and mining within the high yield team is they're fairly averse to it. They will do it, but usually it's a call on the cycle as well. And you know, they're looking for double-digit type yields to kind of compensate them for the risk in the space.
Okay, very good. Let's look at the macro picture and how you're managing it in your respective fields. Obviously, all of you, each of you, follow everything going on in the world, from geopolitics to interest rates to what the Fed is doing, U.S. debt and deficits, and so on. But Paul, we'll start with you. On a day-to-day basis, how much of that is noise, let's call it, and how much how much of it actually directly affects your business from the macro perspective that you concern yourself with, or is it just you head down and you know, you plug away?
No, we do pay attention to it, and it has a big impact on our business, and I think for all of our business, and you know, the single biggest driver these days is rates, and how that impacts all our commodities and appetites. You know, for us, it's a couple of things. You know, first of all is rates and gold prices. High rates, typically, from a U.S. perspective, gold prices go down. And anybody will tell you that they think, you know, if you just look at where rates are and the US dollar correlations, that gold should be lower. But what really has happened is a change in the gold markets. The biggest driver, I mean, that has been the driver and for the last number of decades. That's changed. What's changed is geopolitics. It's the BRIC countries looking to diversify away from the US dollar in their treasuries. And the best way to do that is gold. And so everything that's come out of the U.S. Gold ETFs has flown into the BRIC central banks over the last 2 years. That is a long-term trend. Those central banks are not going to stop buying in the short term. So I think that demand is still going to be there. When rates start coming down in the U.S., I think you'll stop the outflows. I think it's a terrific environment to see the gold price appreciate. The second impact of rates is, you know, what does high rates put a stop on? And you know, we all know the thing that has the most leverage is real estate. And so we see it here in Canada. You have a bit of a crisis in terms of people's incentive to build housing, and it impacts the housing market. But the number two thing that we leverage is when you buy a car. So many people lease a car. And so what you've seen is high rates has reduced the rate that people are buying new cars, and that's created a bit of a wind pocket for the battery metals. But as rates come down, people will get back to buying cars, not just ICE cars, but EVs. I think you're going to see the wind come back behind the battery metal sector as we see rates going down. And maybe the last thing on that theme is risk appetite. High rates, cost of lending is higher. It impacts people's risk appetite. But it also impacts the way that people think about long-term cash flows. If you're an investor and you're investing in an exploration project and you say this is something that I think is terrific, but it'll take a number of years to build and I'll get my payback over 20 years, you discount 20 years of future cash flows at high rates, you don't get a very high value. And so high rates impacts risk appetite. The great thing about that is rates are about to come down and risk appetite is going to go up again.
And Roderik, do macro headwinds and tailwinds affect your day-to-day decision-making, would you say?
I think significantly less than for Franco-Nevada. I think for us, we're commodity agnostic. We can do everything apart from thermal coal. We've done gemstones, we've done quarries, we've done high purity sands. So that's different than such a massive economic driver such as the gold price and how governments use that. What we do see is, with regards to macroeconomics, obviously, if equity markets across the board, not just for mining and metals, are struggling, people are considering alternative forms of getting cash into their balance sheets, and we're busier then. So we see that right now with pretty down markets in the junior and mid-tier equity space. We see that there's a lot of people who are considering alternatives. And then overall, we also don't really take a view on commodity prices. So we've just done for us, a decent-sized copper deal in Australia. We're all bullish on copper, but we don't necessarily do that deal because of that. We do that deal because we run our sensitivity scenarios, and it's a great project, and it's a strong mine once it gets up. And that's really how we do our things. And we also know that commodity prices are cyclical. Things can happen very suddenly. So we just need to have our loans robust enough to go through these cycles.
And John, you talked about your mandate and the various buckets and the various funds. Would you say that you and your team and your approach is always top down, bottom up, or not necessarily?
Yeah, I mean, with the exception of the precious metals fund, which because as I mentioned earlier, it's sort of always invested, doesn't really make commodity calls. So that's 99% of what we do there is bottom up. But across the rest of the firm, you have to be macro. You can't be invested in the commodity space and not have a view on each and every commodity you're invested in, of where you are in the cycle and what long-term, short-term, even medium-term supply demand looks like. And obviously, since the 2000s, that then taking that the next step further, you have to have a view in China, and that really hasn't changed. We have a Beijing office with a number of employees there. A Hong Kong office with a view on China. So I think over my career, over the last probably 10 years, we've spent a lot more time with sort of large brokers, getting granular view, boots on the ground in China, and understanding what's going on there. That's extremely important, and that continues to be, I think, the most important macro driver for most commodities. And so within our global fund particularly, our Canadian mandate's less so. We have to have a view on commodities, and that comes down to macro analysis.
Now, there's a gentleman who may or may not be in this room. He's a junior mining CEO, and he was quoted as saying that in a news release, he said that investor sentiment in the resource sector and financings are at an all-time low right now. For each of you, do you agree with that, or is that maybe a bit of an exaggeration? How would you define it?
We're definitely at a low. Having lived through the post-Pre-PDAC phase in the late 90s, I'm not sure we can say it's an all-time low, because it flattened, all demand for any exploration plays. Risk appetite is very low at the moment. But I'd say and I think we're close to a turning point. And some of the indications is that for good quality discoveries, you are seeing good valuations, you're seeing good interest. The market's gone from being totally not paying attention to differentiating, and I think those are the early stages of a turnaround. If you look at a play like Snowline, if you look at Newfound Gold, these are very early stage exploration properties, but they got a $800 million market cap. And so I think we're close to the inflection point, and I think as we see more quality discoveries, I think that risk appetite will come back.
Roderik, for you?
I agree. I also don't know if it's an all low, but it is low. But I also think a lot of us are to blame, right? Like we haven't been promoting this industry in a positive way. I would think if you asked 50 people on the street, what does copper do? People don't know. People want to buy a Tesla, but they don't know why. They don't think about it. Recycling is not an issue. And governments have been putting out programs and making promises by 2030 this, by 2035 that, without having any idea about where those metals are going to come from. And we should be shining. The whole strongly civilized economy should be throwing money at us. Responsible mining, do it in a good way. Yes, we're going to make a hole in the ground, but we're going to do it in a way that it's responsible. And we're going to do it in a way that sustains this change into an industry that is having a lower impact on the environment. And the only way to do that is by developing new technologies, developing new systems, going away from combustion engines. And for that, you need this, and you need everybody in this room. And so it's a strange thing for me. I don't understand why. But yeah, we are at a very low point, and it just makes me wonder even more why other assets that, in my view, don't really have a very strong value at all are reaching new highs, and people are speculating on values of that. It's like crazy.
John, what do you think of sentiment right now based on what you've seen in your career?
Yeah, it feels a lot like 2015 to me. 2015 was worse on a performance basis. I think, if you took a number of commodity indexes, specifically the golds, they were down 50% that year. We're not that bad, but certainly I think what the quote that you mentioned as a reference to is the ability to access capital. That is as bad as I've seen it. Like the ability to raise capital for juniors this would for sure be at a low, if not, the lowest I've seen over my career. But the performance, I would say it's a low, but not as bad as I've seen it. Like I said, 2015 was a minus 50% year. On the positive side, 2016, at one point our fund was up 120%. In 6 months. The reality with this space is that when it turns, it usually turns so quickly that there's just not enough time for people to get involved. And I think it's been one of the issues historically over the last few cycles, is that when things have turned, they've happened so quick that the generalist investor hasn't had a chance to get engaged and participate in the upside, and then they just step back because they've missed it. So I'd like to see longer cycles, not shorter cycles, but we obviously don't control that. But I would say that when it comes to accessing capital for juniors, I would agree that this is as bad as it gets.
All right, so sentiment is low, but Paul, and again, this is for each of you, this must present tremendous opportunities for a company like Franco, right?
It does and it doesn't. We often say for our business that the best environment is a lukewarm environment. We want an environment where people have the confidence that they can go ahead and build new mines, but we don't want money to be available on crazy terms. We want it to be rational, so that's why lukewarm works well. When sentiment dips too low, you always need equity to advance projects. You need equity to build projects, and if people just can't raise the equity, they either don't build the mine or they end up having to sell the mine. So I'd say right now, I'd actually prefer a stronger equity market. I think it would help us get more deals done, and I think we'll get there.
Roderik, we were talking earlier, and you're saying that you are seeing opportunities, especially in the area that you're operating, which is debt primarily.
Yeah, correct. When we really see a strong correlation with strong equity markets, I have more free time, and weaker equity markets, I'm much more busy. Obviously, when you do $5, $10, $20, $30, $40 million deals, it's smaller. When we do a loan, we often still need the equity. So what Paul is saying, we still dependent on people being able to raise equity, and it needs to be at sensible prices that's not providing excessive dilution to the company's shareholders. But for us, it's cyclical. We have in our third fund, we have a capacity of 20% to do non-secured debt financing. So it's basically allowing us from previous two funds where we've learned that when times are really quiet, we can do other stuff. So we can participate in equities, for example, which we have done. That's a way to keep money at work and to keep investors happy as well. But overall, it is providing for us for more opportunity in this market.
Paul, I don't mean to give you indigestion perhaps after lunch, but I'd be remiss if I didn't ask you about the Cobre Panama investment and First Quantum and the situation there. We talked to Rick Rule a while ago. He said he was adding to his Franco position. He thinks the stock at that time had been unduly punished and the valuation just didn't make any sense based on what's happening in Panama. So do you have any updates for us, and are you hopeful and confident of a positive resolution?
Well, thank you. And maybe to start off, the reason we love royalties, and you should love royalties, is because of the upside optionality that they bring in. And right now in Franco-Nevada in our stock, our biggest upside option is Cobre Panama. With what happened, we have lost more than the value of the asset in our market cap, which is unfortunate. But it does mean on a go-forward basis, anything good that happens is all upside to the stock price. So the big question is, can the mine get restarted? I'm hopeful it can. It'll take a bunch of work in Panama. So many things came together at the same time that resulted in a big protest. A lot of that was discontent with the government, sense of corruption, tied in with some anti-mining sentiment. But it is what it is. Haven't had a protest with that amount of force there'll need to be a lot of education in country to get that turned around, to lay the groundwork so that a new government coming in can say, we want to renegotiate this, it's good for the economy, but it'll also be politically popular. That'll take some time. And so in terms of update, the terrific news was First Quantum was able last week to do recapitalize their company. Very big equity financing, $1 billion, $1.6 billion of bond refinancing. They raised another $500 million through a prepay. So they really changed the complexion of their balance sheet. You know, previously they were looking at repayments due starting next year. They've pushed that out a few years now. So they're on a very strong footing now, that they can take their time, get it right in Panama. I think we've got a good shot at a restart.
So there's a perfect example of risk in the resource sector. John, how do you approach investments in terms of managing your risk, and what do you look for, and what are some red flags that immediately take you out of an idea maybe?
Yes, so it kind of depends on whether or not we're talking about a producing asset or a non-producing asset. I think, you know, for producing assets, it's pretty standard. I think, you know, we would all look at a producing asset the same way as far as thinking about the production potential, the margin, the free cash flow generation, and what's that worth, and what's the optionality beyond that. I think probably where we spend a little bit more time than others is focusing on margins. You know, we have a view that, you know, the most reasonable assumption when it comes to assessing upside is that mine life is extended. Tends to happen. Deposits tend to grow over time, and certainly with newer deposits, they tend not to be fully drilled off when they go into production. But if you focus on margin, then what you're inherently giving yourself better exposure to is to that upside for a given unit. If they find another one and it's a 70% margin versus a 5% margin, that call option is worth a lot more. So we spend a lot of time thinking about margins when it comes to producing assets, and then the other thing would be mine life. You know, mine life is something that's hard to come by in the gold sector, but in other sectors you've got much longer mine lives, and I think what's interesting about long mine lives is you've got the potential to hit multiple commodity cycles. We don't know when a commodity cycle is going to come, but if you have longer and longer mine lives, you're giving yourselves that call option upside to a upswing and an upcycle in the given commodity. You're just stacking the cards in your favor of seeing one of those. So mine life and margin on producing assets, and then the non-producing assets. Again, I think it's, you know, everyone is looking for a big discovery and you know, size potential and looking for, you know, good drill holes. But I think what we probably spend more time thinking about than others on the non-producing assets is thinking about the cost and the time. So, you know, if the return is evident, if, you know, you think it's going to be a big discovery and it might be worth, you know, $500 million if it comes, you know, comes through and you're able to drill off a million ounce deposit, something like that. What we really spend a lot of time thinking about is what's the cost it's going to take. So we know the return, but to get your return on invested capital, you need to know the cost. And if it's going to cost $100 million to drill it off, that's a lot more than $10 million to drill it off. And that a lot of what dictates that is the type of deposit, where it is, and then you got to scale that return on invested capital by time. So if it takes 15 years to take it from first drill hole to production, that's, you know, if to make 4 times your money sounds good, but if it's over 15 years, that's only a 10% rate of return, which doesn't meet our hurdle rates. So again, focusing on time to actually advance these projects, and that varies by commodity and jurisdiction. Those would be the 2 criteria that I think that we probably spend more time than others on.
And Roderik, how do you approach risk when you're assessing a potential investment?
Well, the first ones are the risks that we can't control. Those are the ones that we look at. So it's jurisdiction. Like, you can choose to do a loan in South Sudan or not, right? The second one would be binary events, such as will they get the permits, yes or no. We can try and minimize that. A lot of our loans are not fully permitted mining projects yet, but you can see about peers in the same region, neighbors, quality of the data that the people are collecting, and these are things that we look at thoroughly during due diligence. Commodity price, you can easily run your sensitivities, right? Copper now is $4, running at $3 a pound. If it still makes sense, fine. So that's not really that risk, but We're seeing jurisdiction as a key one, and my mandate is basically, it says strong jurisdictions. And very often we take security as a registered security on the asset in country. Sometimes we do a share pledge of the subsidiary shares, but that's something that is, for us, it's the key thing. It's like, where's the project? And most of our loans have been in the United States, Canada, Australia, most of them in WA, so it's very strong mining jurisdictions. And we see that as de-risking massively. Then secondly, of course, when you come in pre-project finance, the projects are less well defined. Sometimes there's not a definite feasibility study outstanding. There's not the detailed engineering that has been done. And then it really comes out to experience. Like, we've got 7 guys doing the job that I do, which is seeking, closing, and monitoring loans. They all have a technical background. They've all worked in mines and smelters and mills during their career. And screening and understanding the technical aspects, and then finding out, okay, there might be a tailings issue here. Let's get a tailings expert in place that understands Chilean dry stack tailings really well, for example. And then we focus on that. Like, we don't work with a checklist that many of the larger banks have. It's like, just write me a technical independent report and just, here's $200,000, do it. We actually focus individually on the technical risks, and we deep down into those with expertise that we don't have internally. And then it's a matter of getting comfortable. And the key thing then is, like, once you've got the money out, is working with the borrower and creating that relationship, that you get your monthly or your bi-weekly calls, that you understand how construction is going, how project development is going. And then also, what's also very important for us, what we're seeing is that staying in this partner role, because things don't go the way that they want to. Sometimes your ball mill breaks down, and they need the extra $2 million to cover that quickly, and they can't do a raise, and they need you to help them out. And that's then when we step in, and that's when we're really coming back to this trust issue that I mentioned later, is getting into the industry and being seen as a partner, not just as a lender, but being seen as somebody that, okay, we take their money, they've been a super good partner, we now need the extra $2 million. They make up a presentation or an explanation for what happened, why it's not going to happen again, and then we come in and we say, like, look, we're going to help you out now, and we know you've done the diligent work, you've done the technical estimates, you've got a proper scope of work, you have the people to execute it, you already ordered the long lead items. We're going to help you get that mill back up and running. So those are risks, and we're covering those by, firstly, we have the money, but the counterparty needs to do the work, and they need to build a good project, de-risk it, don't overlook things, and just do a diligent job. And I think that's where the whole management quality comes in. So when we DD a deal, management quality and the experience the team has is a very big aspect for us.
So we're talking about royalty and streaming, private equity, asset management. Paul, we'll start with you. Do those 3 things intersect and converge sometimes, or not necessarily?
Well, they do, and in a couple of ways, and probably the first of those is we're always looking for good projects, and probably the best 5 or 10 minutes of my time I've found over the years is sitting down with John and asking him what he's investing in, what he's liking in the sector. John is one of the best managers in the space, one of the smartest guys, so I always try and follow what he's looking at. If you're not invested in his fund, you should be. If you don't do that, at least sit next to him at lunch and find out what he's investing in. He's one of the leading guys. But more seriously, in terms of working together, you get 2 types of markets. In a bull market, by definition, there's too much capital chasing deals. And for us, we don't work together because we're all competing. But in a bear market, it's completely different because by definition, there's not enough capital. And so one of the big questions we're asking when we put capital into an asset is, where's the other capital going to come from? And so as financiers, we really need to work together in a bear market. What do you need to turn a market around? You need success. If there's a play or a few plays that are successful, investors make money, that's what changes the sector around. If there's success, that'll draw money into the sector. So we really are incented. We need to work together. We need to identify what are the good projects. If we can jointly finance those projects, create successes, that's what's going to bring a lot more money into the sector.
John, do you have any compliments for Paul?
I was caught off guard there. No, thank you for the kind comments. I think when it comes to the intersection, we're all looking for good projects. I think, as Paul said, what we're doing is all the same work. I think where it differs, though, is that our funding, our capital base is different, and so our ability to think truly long term is quite different. Paul's capital base is effectively infinite, so he can take very, very long-term views. Roderik's would be probably, as a lot of private equity funds, I don't know his fund, but they tend to be more finite, long but fixed. So you got a fund that's got a couple of years to deploy, and then you got a harvest period, and then ultimately you wrap the fund up. Issue with mine is that my investors can redeem me on a day-to-day basis, which makes it very difficult to take long-term views as you need to in commodities and match that against your demands from your investors. So I think where it differs is ultimately our business model, our funding model, and what that affords us the opportunity in terms of the time period that we can think and the type of risks that we can take. And then on risks, the type of risk that we're willing to take is quite different. Paul's sort of a mezzanine finance, business, and a great business. It sort of sits in between equity and debt. Roderik's is probably arguably similar, probably more slanted towards debt. I mean, even though private equity say there's an equity in there, their actions are much more debt-like than equity. And I'm an equity fund. We do have a high yield group that look debt, but myself, I predominantly focus on equities. So where it also differs is where we sit within the capital structure.
Roderik, you've said that what Nebari does is an alternative to royalty and streaming. So would you say that what you do runs parallel to royalty and streaming, or sometimes they intersect and then you're kind of in bed together, perhaps on certain deals, and maybe almost helping each other to a degree?
Look, it always depends, but if a company needs $5 million, then they're not going to do both, right? They're going to do either or. They're going to do an equity raise, they're going to do a small stream or a small debt facility. As was pointed out before, the larger ticket sizes, everything needs to come in, because we all want to have people to have skin in the game, and especially the equity holders. I think in that context, working with great companies such as Red Cloud, they know us, they got to know us because we're sometimes filling this gap that they need, because they're as an advisory making sure that the companies get money the best way that they should and could on time for the purposes that they need to use it for. You need to have these different levers to pull, and sometimes you want to pull in everything. Sometimes you just want to do equity and some debt, and I think that's where the sophistication of the market comes in with financial service firms such as Red Cloud, that they can look over this whole scale of the industry, know everyone, and then can make up for their customers the best solution, and having different levers to pull from, such as a Nebari. Maybe there's other Nebaris out there. That's really the best situation to be in, because the more optionality you have, the better for everyone. And working together is a natural outcome of that.
All right, very good. We have, we've got about 4:45, 2 minutes, just 2 minutes. Okay, we have 2 minutes. So does anybody have any quick questions here for our guests? There's one over there from Rick Mazer.
Pierre Lassonde, I believe, was on BNN and stated that Canada's pension funds invest their capital, 97% of their capital is invested offshore, and 3% only here in Canada. And he kind of tied that to the demise of the Canadian mining industry, with Noranda going away and Vale and Falconbridge. Paul, could you elaborate on Pierre's comments?
Sure. Was just spending a bit of time with Pierre down in Florida, and he was taking investors through it. Pierre in particular has been pushing to see investment in pension funds spend more of their money in Canada. He's done a lot of work with a couple of groups that have compared Canada versus Australia, which I think are very comparable markets. And in that market, the Australian pension funds invest vastly more in their own country than here in Canada. So that's where we'd like to be. And there are two ways to go about it. The one is that you require funds to do it, but the other is it's a private market, and people put their money where they think they're going to get the best returns. So I really think there are two sides to it. We need in Canada to make investing in the mining industry an attractive investment, not so that we just force the pension funds into it, but that they're also attracted to do it. And that becomes a long debate in terms of what all we need to do around that. But one of the ones that is raised all the time is permitting timelines. Creating an investment environment where people can be confident. If they do have a good discovery, give them the confidence they can move that through to cash flow.
Any thoughts?
Lots. Yeah, I couldn't agree more. I've been in heated arguments with people over this over the last 6 months, and they'll make the exact same argument that Paul referenced about Australian does it, why shouldn't we? And what Paul said is just spot on. You can force people to do it. Working in a large asset manager, my job is to generate returns. and when I did my master's program, one of my mentors there was a CIO of CPP at the time. And if you think about how CPP and the large Canadian pension funds run, like they run $500 billion. Like they can't outperform the market because they are the market effectively. And when you look at Canada, we're about 3% of the global market. So about 3% of their capital is going to be here. I mean, their job is to generate returns for their stakeholders, which is effectively, the Canadians in the room. So I believe in free capital. I don't believe in forcing capital to go places. I believe if you want to attract it, you got to do exactly what Paul said. You got to make it more attractive from a return standpoint rather than mandating it. And, as I mentioned earlier, time is the enemy of all investments. It really is. And so by shrinking that time, you're inherently boosting the return on capital.
Teresa, do we have to wrap up? We have, okay, one more question. One more question. Who do we have? Jamie Carrasco.
You talk about returns, but the problem I have right now is that 40% of the funds in the S&P 500 are sitting on 7 stocks, 70% on 10% of stocks. So at what point does the advisory side wake up and stop chasing returns and do the right thing?
Does the advisory start chasing returns as in going investing in those same stocks?
No, 80% of a returns of a portfolio's return is asset allocation. If 70% of the money is sitting on 10% of the stocks, how is asset allocation being played out? And where is the long-term return for the end user of the funds? My problem is that there is no fiduciary standards when you have that kind of imbalance into, 7 stocks? Isn't it, weren't we redoing the year 2000 all over again?
Yes, there's a concentration issue with the broader market. That's what you're saying. And that's absolutely true. And I think that's a problem all asset managers face, is that sort of passive to active call, where passive has outperformed active for a number of years, and it's bled money out of active management. The people that make these type of decisions that we've been talking about whether I go overweight materials, whether I call the bottom of the cycle, those people are dwindling as passive takes market share, and as passive takes more market share, you get automated buying of those same 7 stocks. So it becomes a bit of a circular reference, and that is a very, very good question. I don't have the answer to it, to be honest, about how that all plays out, and ultimately, we know there'll be a day of reckoning for that, but when the music's playing, there's a lot of people that have to dance.
Okay, we'll wrap it up there. Thank you, everybody, and thank you, gentlemen. We appreciate it.
Thanks, Bob.